Hi guys, today we have to talk about what's happening in the automotive industry because as you can see, there are regional banks that are exploding and there are problems that all of this subprime lending and all of the lending, not even subprime, has brought to light. So here is Kenneth, our resident expert on automotive. And we're going to go through what's really going on, behind the headlines and supporting the headlines and behind the headlines. So let's begin. All right. Okay, we're going to start with this first slide. And what is this, Kenneth? Even top earners are falling behind on credit card and car payments. What do you think that's about?
Well, I mean, when we're talking about the overall economy and the debasement of the currency.
Debasement? What do you mean debasement? Shall we play a little central bank because this is how
stuff.
they do it? Yeah, that stuff.
They
Okay.
love that, right?
Oh yeah, they do. It's the only tool they really have.
So when we're talking about even those top income earners feeling the pressure of the loss of purchasing power while everything else in cost is going up, it really shows you that this might not be, let's say, the issue of because you're not earning enough.
Oh, well, what do you think the issue is?
Well, it would have to be that now every dollar that people are spending, while it is having less purchasing power, that loan that they're taking out for that vehicle, it's not going down with their purchasing power. It's actually going up. It's doing the opposite.
Yeah. I was reading that pay raises are also getting harder and harder to find as the employment market is shifting.
I think actually just as of yesterday or like last night, it even came out, Amazon is taking 30,000 corporate jobs away. So yeah, we are seeing the effect of the Federal Reserve saying, well, it's time to cut those interest rates while the overall job economy is slumping down and government shutdown too, going in with that, people furloughed.
So let's kind of stay there for a minute and unpack that because you made a really powerful statement and it's something that people really need to understand. Yeah. Because with the anticipation of those lower interest rates, the markets are hitting new highs.
Oh, yeah.
So let's unpack what it really means for them to lower those interest rates.
Yeah.
Well, why do they do that?
Well, by nature, they want to be inflationary, but the question really is, well, why do they need that inflationary tactic of the lowering of interest rates? And I believe at least that you've made the point, well, if they need to bring in all this capital to back these stable coins, that would be a reason why they're like, okay, we need to start cutting these rates now so we can turn on the printers.
Well, yeah, that's true. And we are starting to see pressure on a global basis in the stable coins. Yeah. But really, we have been feasting on cheap debt. Yeah. And the loss of the employment or harder to find raises, et cetera, that's all deflationary, right? Yep. And so there's only one way. I mean, they make it really simple. It's only one way to fight deflation, and that's obviously it's with inflation and corporations having the ability to just feast on free money.
Oh, yeah.
And that helps them at the top because they get it first.
Right, yeah, you get those bigger payouts for the executives, the presidents of the company and everything. But all the people that are on the street level, the people that we speak to, right, every day, they're the ones getting cut.
Exactly. Yeah. The K-shaped economy that started with COVID is well in place today with those at the tippy top, because we're talking also about people that earn $100,000 a year and more, which kind of sounds like a lot, but boy, you need two people that are working and they're still living paycheck to paycheck to paycheck, right?
Absolutely. Yeah, that's, it's that widening of the gap between the middle class and the upper class where they want to eliminate that middle class.
I think they they've come pretty darn close
Yeah.
to completely annihilating it, if not more. But I found this to be like a very interesting headline. The sheer amount of debt consumers are carrying in their trade-ins should be a wake-up call. Now, you worked at what part of the automotive industry did you work?
All of it. I was sales, I was finance, and I was on the desk. So I saw
Okay.
every aspect of it.
So when you were part of that, because it's been a little while now, but did you see the trade-ins that still had debt attached to them and that debt being rolled into the new car payment?
Oh, it was the oddity if they didn't have a loan on the car that they were rolling into the new vehicle, even with aggressive rebates that the manufacturers put out there. That all that is a tactic for the manufacturer to get those people to roll the debt into the new vehicle, because it's a shell game. If they can offer a big enough rebate, it makes it look appeasing on paper to be like, okay, well, I've got $20,000 of negative equity, but they're giving me $8,000 in rebate. So really, it's only $12,000 of negative equity that you're just rolling right into that loan. And also, a lot of times to hide that debt, the people need to get a more expensive vehicle, so a higher price.
So, okay, we'll talk about the inflation of the vehicles, but why would they need to get, I mean, aside from the inflation, why would they need to get a more expensive vehicle so that that debt to loan ratio, I mean, you can explain that better than I do having worked in finance.
Yeah, absolutely. So, right, banks, when they're looking at picking up a loan for a vehicle, they're going to say, well, what is the loan to value ratio? How much money are they trying to borrow versus how much is if it's a new car, how much is the invoice for this new vehicle? So they'll be willing to go sometimes 130%, 135%.
Whoa.
Yeah, if you've got good credit, they're like, sure, take on all the debt, right? But so what you have to do in order for, if you have more negative equity, the dealerships really are the ones that are coaching people into, well, hey, you can't just trade straight across. You need to get a little bit more expensive vehicle so that loan to value comes in line, so the bank will even pick up your loan. And that is a symptom of the people not having the cash to pay down that loan themselves, right? If they're relying on the manufacturer's good graces of a good rebate, and the bank's just saying, sure, we'll pick up the loan, just make sure it's an expensive enough vehicle, it's a bad storm.
What does it do to the car payments?
Oh, they balloon.
Because they still have to pay off whatever that negative equity was.
Yep.
Then on top of it, you have the new car loan.
Correct.
How in the world are people even qualifying for that?
I think it's something that you've talked about where banks loosen financial policy, and that's going on right now too a lot with this whole economic climate, we could say.
Oh, yeah, because they have to, when you're in a Ponzi scheme, you always have to get new money in that Ponzi scheme.
Right.
And it's one thing to go ahead and print the money, and that certainly makes a difference in, whoever gets to use it first. So these large corporations and governments get to use that money first when it has the highest level of purchasing power. But as it trickles down, because what we're seeing is that the underwater car loans hit a 4-year high, and they've been constantly growing. And that really is a sign of distress, right?
Right, absolutely.
Well, what happens when these people cannot pay those car loans?
Get repossessed.
Whoa. Then what happens to those people's credit, even if they started out with good credit?
Yeah.
Are they eliminating things to enable people to even borrow more, or they're just kind of juggling the formulas?
Right. So that's where we look at prime lending versus subprime lending as well. So interestingly enough, if let's say you had good credit, you got into a car loan that you could not repay, and so you repoed that car, there are banks that they will look at you and say, okay, you've just repoed a vehicle, but you had decent credit in the past. I like the big loan amounts that you've taken out. Sure, we'll pick you up on this car. They'll, cap you at X amount of dollars, $25,000, whatever that is, and they'll give you a nice loan for the generous interest rate of 21.99 or 22.99%. And people will do that because you need a vehicle.
Wow. I mean, how do you ever get out of debt in those circumstances?
Can you?
I mean, seriously. Here, the auto loan delinquencies have jumped 50%. 50% from just 15 years ago.
Wow.
So that was like, what was happening 15 years ago?
I can think of something.
Yeah, what?
Maybe a global financial crisis?
Ta-dam!
Right.
So no income group is immune. Prime and near prime borrowers who typically have good credit scores are actually missing car payments at the faster rate than subprime consumers. Whoa, what does that tell you? If higher credit consumers are missing payments faster than subprime, because they want us to just think this is a subprime issue, right?
Oh, right. That would be the most logical conclusion to come to. Oh, it's just the people that have bad spending habits. But not the case.
No, and those spending habits are being supported because it keeps the engine going. But how can they? Oh, let's see. How can they? Oh, how about packaging those loans up into financial products and selling them to you? And you don't even realize you're taking that risk.
Yeah, that is actually the key word that I see is securitized. And when I see that word, I don't know about you, Lynette, but I start getting a little worried. Okay, what are they doing with this debt that these people are taking on that they cannot service?
Kind of sounds like risk transfer from the few to who are really deemed too big to fail to the many. Does that make a whole lot of sense?
No, not to me. What about to you?
It doesn't. And, when you're looking at this graph from the Federal Reserve Education Department, the Fred, motor vehicle loans owned and securitized, that is just this huge upward trend.
Yeah, it's parabolic.
So who's going to pay? Who's going to ultimately pay for this? Really, I mean, I could call it financial abuse.
Yeah. Well, I'm going to wager that it's not the few that are going to be paying for it.
Well, we can make different choices, though. And I think we really need to make different choices because all they're really talking about is creating even more inflation. Right? And, they're just looking for an excuse to lower interest rates, which is really, when they do that, every time a central bank does that, what they're really telling you is that currency is too strong. It has too much purchasing power in it, and they're going to be taking it down. How does that impact everybody else?
Right. That is the big question because, again, at the street level, these are the people that are really being affected.
So is there part of the strategy, because you are a key strategy specialist at Zang Enterprises, right?
Yes.
And so he's working with clients on a day-to-day basis and building out these strategies in layers. So is there a layer in this strategy that actually deals with this fixed loan debt?
Absolutely. It's one of the most fundamental layers of the strategy, and it's about getting debt-free after that first revaluation of the gold, because you don't want to go through a currency reset with any kind of debt.
Right. Well, fixed rate debt, I mean, this is the strategy that the governments employ.
Right.
They repay this debt in this country, but this is true everywhere in the world, with the fiat money, so in this country it's US dollars, that have zero value. They mean absolutely positively nothing. So that is a way, and you look at all of that fixed rate debt, right?
Right.
To determine, well, how much gold do you need, and what kind of gold do
Correct.
you need?
Yeah, absolutely. There is diversification within the strategy to make sure that our clients are getting the most benefit out of that asset, out of that gold that they're acquiring.
So what's the first thing you do when you talk to a new prospect or somebody that wants to understand more about the strategy and how it really benefits them?
Well, one of the first and most pivotal questions that I make sure I can understand where they're coming from. So I'll just ask them, hey, what was it that you saw or heard that led you to feel like this was important to look into right now? Because I believe as time goes on, we're getting closer and closer to the terminal endpoint of this currency's life cycle. More people are going to be seeing the signs, right? The writing on the wall, so to speak.
I hope so.
Yeah, right.
Quite honestly. And the sooner they do see that, the sooner they can get protected. So what's the next thing that you do once you understand what their concerns are?
Well, that's going to be figuring out what their goals are personally.
And what happens because a lot of times people don't really know what their goals might be. So they might be feeling very uncomfortable and even scared about the different things that are happening.
Yeah.
So how do you help them if they need help defining their goals? Some people will know what their goals are, but if they need help defining it, how do you do that?
Well, it's a conversation. It's about knowing, okay, when you are looking at your legacy, your future that you're trying to build, how does our strategy bridge the gap? Because we want to meet you where you are to help you get to where you want to be.
Yeah, that is so critically important. So some people are saying that what's happening in the automotive industry with these loans is akin to what happened with the subprime mortgages, right?
Yeah.
In the crisis. Do you see it that way, or how do you feel that those, are they the same? Are they different? What do you think?
Well, I can say that personally, I view it as the same, even though they're, vehicles versus mortgages. But I also think that it's very important that you're covering these data points, because one of the most important signals that the average family is getting right now is looking at these auto loans, how the price of their cars are going up, the monthly payment is going up, but a lot of them are misinterpreting it. They're misinterpreting what that really means. So they hear that the average new car price just topped out over $50,000.
Yeah.
And they just accept it as the way things are, right? But as an architect of our sound money strategy, my job really is to question what that blueprint of normal is. Let's think about what it really stands for. We're normalizing a 7, right? Because we're normalizing a 7-year auto loan, which,
Whoa.
right? It's functionally just a mortgage, right? At that point,
right.
On a piece of machinery that loses nearly 70% of its value in that same time frame.
Wow. That is a really good point, because as soon as you drive that car off the lot, is that true for used cars too? Because there's a markup in there, right?
Yeah, right.
So the new gets hit the most.
Right, yeah. The new is going to take the biggest hit typically. Even if you do go with pre-owned though, again, most people are rolling their taxes and the fees into that loan. If they've got some negative equity in a car they're trying to trade in, again, banks, because of their loose fiscal policies, they'll still take on some of that negative equity of a vehicle, even into a used vehicle. Yeah.
Well, why not? They're turning around, creating a product out of it
Right.
and then selling it to you and me.
Right.
So who's
Right.
really taking the risk?
It's a guaranteed pre-packaged financial loss that we've been conditioned to accept as a rite of passage. And hey, that's just what happens when you get a car. And I think that's one of the first cracks in the foundation of what people are seeing and perceiving. But you know, when we talk about the delinquencies going up, right? That's the second piece that you brought up, that second piece of data. And a lot of people will look at these delinquencies and they'll say, oh, it's just a sign of consumer weakness. You know, it's just part of it.
Well, it is a sign of consumer weakness because consumers were by design, you know, put in that position. And then there was another question that I want to ask you about, which is the autonomous vehicles.
Oh, yeah.
Right? And the smart contracts on top of them. Because, wow, this was way back in 2015 where an IMF report that I was reading talked about, well, if you miss a payment, then the car can lock you out and drive away. Is that what you're seeing as well? Or what are you seeing regarding that autonomous vehicle?
Yeah, because
smart cars.
The smart cars, yeah. Especially because the increased price of the vehicles on average, how we got to that $50,000 average price is due to these smart vehicles, the Teslas or the Rivians.
It's one of them, and that devalue it. What a good, I hadn't even really thought about that, but it's true.
Yeah.
So these are costing you more, and they have the technology in them to lock you out and drive away.
Wow.
And with the smart contract on there, frankly, there's nobody for you to talk to.
Right, yeah. You're literally going to be left no vehicle with that bad debt, those repossessions becoming autonomous. And the other thing too is with the smarter vehicles, everything becomes subscription based.
Yeah, oh, totally.
Yeah.
That's where they're taking us. That's why they're saying by 2030, you will own nothing. I mean, if they have their druthers, they digitize my coffee cup.
Yeah.
Right?
Yeah.
And so, okay, I can use my coffee cup, but I'm paying for it every single month. Yeah, that's a really, really good point and a little bit scary, I'm going to say.
Right, yeah, it is. And again, when we're looking at the failure of people to service this debt on these car loans, you know, it really, yes, there's consumer weakness, but what we have to look at is it's just the fever, right? That is the fever. It is the natural response to the true disease, which that's going to be the currency itself. That is the sickness itself. It's sick and dying, right? So people are being forced to borrow more and more of a debased currency to afford the exact same standard of living.
Yeah, I don't think people are really maintaining that standard of living anymore, especially when you see people having to borrow to feed their families. Wow. When you're building out a strategy for somebody, do you build out some short-term emergencies in case they need to make a car payment or a mortgage payment or something like that and they're kind of pushed in a corner?
Yes, absolutely. That's one of the most important things to have. We want layers of protection for our clients. So you've got that first layer of cash that you want to keep at home outside the banking system.
Right.
That's your first line of defense to let inflation just eat away at that. And then within your barterability position, one of the most important things is to have that emergency savings.
Yeah, this is what I use, right? It's just a raw pre-33 because desperate governments do desperate things, and I got to see my Uncle Al holding at least 3,000 ounces of gold when it was illegal to hold more than 5. And, a lot of people think, oh, that can't happen again. Gold is not in the monetary system. I don't know. Have you seen how much gold that the central banks are reporting? And we know for an absolute fact that that's being well underreported.
Yes, and then you hear talk about, the beginning of the year, well, okay, audit Fort Knox, and then it just
Nothing.
fizzles.
Right.
Yeah.
So, I'm definitely a pre-33. It comes down to really understanding the true value, the true fundamental value of every single asset. And look, the central banks have made it quite clear that the fundamental value of this is zero, because it costs nothing to create it. This is so cheap to create. And even at that, right? Even at that, once we go digital, it's even cheaper. Well, if money is easy and cheap to create, what's its value? Because more and more will be created.
Right, absolutely. To just keep like you said, the engine going.
Yeah.
Right. And the scary thing about when you talk about smart contracts is that's what creates a perpetual consumer.
Yes. Isn't that true? Because you don't have any other choice. You're going to have to figure out how to make those. But it's so much easier. They're going to make it look so cheap. It's so much easier just to do, and cheaper to do this subscription. And then once they get you in the ecosystem, frankly, they can really charge you anything they want. We've seen it in Europe and other places with the VAT tax that started out it's just 2%, and now it's over 20%, right? So you have to be careful.
Yeah.
I'm going to let you say any closing words that you want people to really understand that can hit home harder.
Yeah, no, absolutely. So, Lynette, what I wanted to ask you is, as the person who has studied these currency life cycles for decades, when you see these two trend lines that we just went over, right, the debt burden for the average family going vertical, while their ability to service that debt is visibly shooting downward, what is that data really a leading indicator for concerning the final chapter of this currency's life cycle and the rules people think they're playing by?
Yeah. Well, if they look at those rules, but really what that leads to is a hyperinflationary depression, because it's only being held together by a loose level of confidence. And those numbers came in today, and you've got a decline yet again. So now they're saying 3 months in a row. But when you look at that chart, it's quite clear that that is on a downward negative trend. So that's what that tells me. And that's why having the strategy in place and executed, because some people, I don't know if you find this, but you're on the front lines with that. I don't really work with clients directly, but you do. Do you find, I used to when I would work, people would think, well, if they just create the strategy, then they're doing something. And that's the place that you start. But is that enough to protect them? You got to execute it too.
I mean, I will say I guess one of the biggest things that I can really talk to with clients is, look, you can buy gold and silver anywhere.
Yeah.
Right?
In any form.
In any form.
In any form. Mm-hmm.
But when we talk about an exit strategy, if you've got this fortress that you feel like you've built up around yourself, and it's a good feeling to feel that way, when the time comes, what if you can't find the exit door?
You're going to have to know where that is. And of course, that is something that is definitely part of our job. Exactly. We are not a one-hit wonder. Oh, you come in, you do something, anything, buy gold, buy silver, and go, have a nice life.
Right.
How do you feel about it? As a strategy specialist working with clients, what is your attitude? How do you approach that?
Oh, I mean, for me, that's my favorite part about what we do, is that we are a comprehensive concierge service for these people. It's one thing to think that you've built a strong foundation for yourself, but it's another to be able to show people this is the exit door. This is what happens when we're on, not only in the midst of a currency reset, but on the other side when the smoke has cleared.
Yep. That is a really good point. And I am going to be doing a piece to show them that more, what you're talking about, the exit strategy, more specifically. Well, this has been fabulous. Have you enjoyed it?
I think time's been flying because we're having so much fun, honestly.
I know. And I think it's great. And I want you to see who it is that the caliber of people that we have at Zang Enterprises. Because quite honestly, I am so proud. Do you want to make a difference for a lot of people, a positive difference for a lot of people?
Every single day when I go into the office, that's what our goal is. That is the mission.
Yep. Would you say that's true of everybody, or do you think that maybe that's not?
Everybody that works at Zang Enterprises, absolutely. Everybody in the industry, not so sure about that.
I'd agree. Well, this has been great, and you'll come back again because he's definitely an expert in a lot of areas. But it comes in handy because we have people that worked in real estate. We have automotive. We've got it in retail. So we've got it from all the different sectors, or not all of them, but a lot of the different sectors in the economy. We have people that know it firsthand, and that's the best place to get good information. Plus, you're constantly studying.
Oh, yes.
We're all lifelong learners at Zang Enterprises, no doubt about it. So this has been great. And you guys, I hope you got a lot out of this. Kenneth will definitely be back again talking about lots and lots of things,
Yes.
not just this area. But when I was putting this piece together, I said, well, who knows more about this industry than I do? And that's him. So here he is. Thank you so much for showing up. Thank you for showing up every single day for your clients, too.
Absolutely. It's the least I can do.
Awesome. And until we meet again, I absolutely know you're meeting some of the community. We have a very strong and powerful community. We need to grow that globally and demand redeemable gold back in the monetary system again. I know together we can move mountains. We can do anything. All we have to do is come together in community. Till next we meet, please be safe out there. Bye-bye.